Super exciting podcast, super exciting session today, guys. I have got the queen of self-managed super funds, the hot topic. I'm
Woo!
so excited. My guest today is Kerry Bridgeland, self-managed super accountant and principal of Bridgeland Finlay Accounting. Kerry, welcome to the show.
Thanks for having me. It's a hot topic, extremely hot. So I'm ready to go. I'm ready to give all my answers and tell you all about it.
Okay, so we're going to be focusing on this new, let's call it a proposal that government is proposing for self-managed super fund and the $3 million mark. So this is a hot topic at the moment. Labor's proposing their 3 million super tax. I reckon it's probably going to be causing a little bit of chaos, not only in the accounting circles, but I think also in with investors and with any of you guys that are sitting in this with your 3 million plus in your self-managed super fund. Kerry dived at the opportunity to be on, so I'm super excited to hear Kerry's take on this. So let's just dive straight into it, Kerry. And thanks again, for joining me. I really appreciate it. It's always great having a professional to tell
You're
me
welcome.
about it. Do you want to just give 2 minutes about yourself so that the audience know who you are, what you do, and why are you the perfect person to speak about this self-managed super fund today?
Well, obviously, you've introduced me. Thank you, Mish. Thanks for having me. My name's Kerry Bridgeland. I've been a tax accountant for over, oh, geez, I'm going to give my age away, about 29 years. Super is something I'm very interested in because it's the only thing in Australia that we have that gives you tax-free earnings. So there's not much you can get tax-free. So super has been something, a passion of mine for many, many years because it really is the only tax planning tool we have left in our little toolbox. So for succession planning, etc., I do a lot of planning around superannuation, setups of superannuation funds, pensions, and discussions with clients about how much money they need
Hmm.
and what the tax advantages are for having their money in super. So as I said, it is one of the only places you can have tax-free money. They say everything in life, tax and deaths, not in super funds, not
Right.
till now.
Until
So
now.
this is yes. So I've been in the super fund space for a long time. Like I said, it really is something. If your accountant's not talking to you about super, then you're
Yeah,
missing
you got a
out. So
problem.
it is, like I
Hmm.
said, tax free, can't go wrong. So it is. There's a lot of money in super. Australia is the only one in the country that set us up like this with self-managed super funds. So super funds also, what people don't know, underpin Australian economics. If you think about 12% of every person's wage in Australia, 25 million people is going into super annually.
Wow.
Do your
Yeah.
maths on that. Do your
Yeah.
maths on that, people. It underpins us when we go through recessions. We look to super funds, and they build. They put money into our infrastructure. They put
Yeah,
money
of
into our
course.
buildings. They put money into all of Australia, as well as obviously overseas. So I think people forget that side of it.
Yeah.
A country without savings, it's like an individual without savings.
Yep.
So we're not debt equity. When you look at debt equity ratios and you think of all the money in super, just think about that and feel probably a bit better to be an Australian right now.
So let's just lay it out. What exactly
Mm.
is this tax and why is it sending shockwaves?
Right. Well, I'll answer both.
Let's
So I'll
let's
answer the
dive
first
straight
one. What
into
is
it.
this tax? Yes. Right. So it's called Div 296. So what it is it's a tax on super fund earnings. Now let's over 3 million, but let's put this in context. If you had 3 million in your fund last year and you still had 3 million in your fund this year, no extra tax. Right.
Right.
Now, let's say you had $3 million in your fund last year. Now you've got $3.5 million in your fund this year.
Hmm.
What the government will do, they'll allocate for additions, withdrawals, etc. Then whatever's so take out the additions, take out the withdrawals, and any of that growth from 3 million to 3.5, it might turn out it's only 3.2, it might be 3.6 because you might have withdrawn 400. So it takes into account the addition and withdrawals over the 3 million. What you're left with over the 3 million is tax an extra 15%. So prior it was 15 cents in the dollar. Now it's going to be 30 cents in the dollar, only on the increase in the balance over the,
So only on that 500
yes,
and that could be
thousand.
the difference from last year to this year. Now, instead of being taxed
Yes, from 30 June to
15%,
30 June.
Yeah.
an extra 15%. So it's gone from 15 cents tax to now
Yeah.
it's going to be
30.
30 cents tax. But the crux of this one is it's on unrealized gains, which we haven't done before, so which means your assets could have gone up by 500,000. Let's give you an example. Your fund had $3 million in it last year. We valued your commercial property. It's gone up 500,000. So
Right.
your super fund balance has gone from 3 to 3.5. You've done nothing. It's only on the books. You haven't sold anything. You haven't made anything.
Yep.
That's called unrealized gains. You haven't realized those gains. You haven't sold the asset yet. You're
Yes.
still paying tax on that 500,000 now.
So you're actually being taxed on money that is on paper and not actually that's in your fund or in your pocket.
That's correct. So that's where the
Right.
argument lies. The
Wow.
second argument to this lies that it hasn't been indexed.
Meaning, let's just,
There's no indexation, which means $3 million today in your fund is worth different to someone 20 years down the track with 3 million. For example, I was telling this example to someone today. When I was a kid, I was 9 years old, and Stefan, he's our local hairdresser. He's quite famous. Some of your viewers will know him, Stefan. He bought a house in Paradise Water that was $1 million. And we're like, wow, he's a millionaire. So that's equivalent to about 30 million now. That's how fancy his house was. Now that
okay.
was 1 million then.
Hmm.
Imagine 1 million then. Where does 1 million buy today?
Very little, actually.
So so 3 million in super now in 30
Mm,
years is
mm,
not going to, it's going to be very little, but they haven't
mm.
indexed it. So they're not making it 3.1 million, 3.2 million, 3. They're going to keep
Right.
it at 3. That's where the argument lies right now.
Yes.
That's
Yeah.
what people are so the two things are you're taxing unrealized gains, things money we have not received.
Yep.
Number two, you're also not indexing it. So 3
So
million
yeah,
today is a lot different than 3 million down the track.
so in actual fact, let's just put this into context. So if you're being taxed on capital that you're not realizing, actually what's going to be happening is that's going to be eating into your capital year on year.
Well, you've got to find the cash flow as
Well,
well because you haven't
exactly.
sold anything.
But that's
You
exactly,
might be you might be negative geared with that
yeah.
commercial property. So you don't have any cash.
So that means that for every 100,000 that you got in there, you're being taxed 30%, you're going back 30%, so that's 70,000. Now suddenly your value is 70,000. And if that happens again, you're losing another 30%. So you've gone down 60%, you're down to 40% accumulatively, ishly.
Kind of, yes. But you saw your market value goes from 70 back up to 100. So it's worth 100
Yeah.
again. But yes, if you want to look on cost base, but you need to look at it's all market value, these figures.
Yeah, and as you say, I mean that is cash flow. So I mean if you don't have that cash, you can't pay the taxes. Wow.
Yes. But
Wow.
then,
Wow.
yes, but there's a few ways to look at it on a different side of the coin. The
Yep.
different side of the coin is this only affects 0.5% of all members' balances in Australia. 0.5. Put that in perspective. Point 0.5, very, very small. So it seems to be a storm in a teacup. So everyone's like, why is this storm in a teacup? The reason is because financial planners and the finance industry have a lot of the money in these funds. They're
Right.
managing billions and billions of dollars. But when I say it's only 0.5%, put it in perspective, I think we have 70 funds on our books at the moment. We've got ones that's affected. One,
Only one.
one
Okay.
person.
But you're one accountant out of how many thousand? So I mean it would be very
So they'll
interesting.
all have one or two.
Yeah.
Yeah, they'll all, but it's 0.5%. We're not talking the population that got funds. It's 0.5. It's not even 1%. So it really is, in material terms, from an auditor, we don't look at anything unless it's over 5% materiality when I do my audits. If it's under 5% variance, we ignore it. So 0.5% is really ignore it. But the storm in the teacup is because it's a new tax. People don't like new taxes. Number two, it's not, it is unrealized gains, which we haven't done before. So it really is a small number. It's really inconsequential. We've got to also put it in perspective that many years ago, I think it was 2003, coalition government and decided you could put $1 million cash into your super fund and
Hmm.
get a tax deduction for it. Now, this was 2003, so that million's equivalent to like having 5 million now available. So
Yeah.
not many people have 5 million chump change lying around.
No.
Rich people did have $1 million. Rich people did want $1 million tax deduction. So rich people put that $1 million into super. They got a
Yeah.
great tax deduction for it. Brilliant. They borrowed to put it in. They did whatever they could. Now, can you imagine where that 1 million is now? 24 years later, it's
No.
more than 3 million. Everything
No.
doubles on average every 7 years. Some of
Absolutely.
these funds bought specky shares at 6 cents. So they bought $1 million worth of specky shares at 6 cents. Some of these shares went to $20. Do your
Right.
maths on that.
Yep.
So the Australian public are subsidising these mega rich, 0.5% mega rich billions of dollars in super, and we're giving them their money at 15 cents in the dollar. So what Labor's saying is, should we subsidise the rich? That's the question. That
Okay.
is the only question. Should we subsidise the rich? Now, think about it, 30 cents in the dollar, the highest tax rate of an individual is 47 and a half. So you're still 17.5% better off than you would be outside of super.
Okay. Now, that's all very good and well, and that's for those that have got 10, 20, 30 million in their supers.
Billion
Yeah,
even,
yeah,
billion
sure.
even,
Yeah.
some.
But then you've got your mom and pop who've got 3.5 in their million or, 4 in them, and they've worked all their lives and they've taken advantages of all of these opportunities through the years for the last 30, 40 years to build that up. That's their nest egg. They're now in their late 70s, hitting 80s, and they're sitting with this problem and they're seeing this tax. And as you said earlier, it's a tax retail. When people see more taxes on their earnings, for those mom and pops, is it fair?
I would say, is 3 million enough at 80 years old for you to retire on? The purpose of superannuation, we gave all these tax advantages so you could live in retirement comfortably without the extra burden. So that's okay for mum and dad with 120 grand, 130 grand. You want to stretch that out. You've
Yeah.
got over $3.5 million each, a couple. That's what do you got? $7 million. I think they can live comfortably for the next 20 years on $7 million. If they have to lose 100, 200, $300,000 in stamp duty, moving some things out and about, I
Yep.
think they can afford it, bottom line. Let's be honest here. $7 million isn't enough for 20, even though you pay tax on it. That's I think we've got to stop thinking about the point of where it got to as
Mm,
to the concessions you're getting now, and is that fair on the rest of Australia when we're we're having a housing crisis. When you start looking at everything else on the board, you've got to put it in perspective.
mm,
If Australia was going gangbusters and we had no unemployment, we've got our money from our resources, etc., what we should do, that wouldn't be a problem. But when you've got people starving, you've got people not having a house roof over their head, you need to ask, are we going to keep paying these billions of dollars in concessions to people with more than $3 million in their retirement fund? And I think quite clearly that Labor has got a mandate that the people have said, no, we don't want to keep subsidising the rich.
Yeah, look, from that perspective, I can totally understand it. I get a lot of calls from people who they've saved all of this, they've got their funds in their self-managed super fund. They're asking me the question, do they buy commercial real estate? Well, my natural answer is hell yes, buy commercial real estate all day long.
Yes.
So what happens, with those people that buy, let's say they use 2 million out of their 3 million, and let's say it's a couple. So between the two of them, they've only got 3 million. Okay. To buy a commercial property, they're going to maybe use 2 million of that property. They're going to buy a property that's maybe worth about 4, maybe 5 million. What is the impact of that going to be on their self-managed super fund? Because now they've spent that, but they do have a property that is worth, let's say, 5 mil.
Yes, I agree with that. So I think what will happen there is just better planning. You've just got to think around these things. So obviously, I'm in the industry. I plan to have $3 million in my super fund, I hope. And I hope to have that problem that my property does go up again. So I've got two choices. I can then liquefy some of it. I'm hoping I don't have all my assets in one basket. So I'm hoping I don't just have one commercial property. I'm assuming I'll have some shares, some cash, some other things. If you've been planning well, you're going to have your mix of products in there. So I would probably then look at either moving the commercial property out. If it's not feasible, it's your business premises, it's your farm, it's whatever it is. Then you would think of, okay, do I need to pay that extra 15% tax? How much of a burden is that going to be on me? And you need to look at that. So if the cash flow is a burden, people might liquefy. If cash flow is not a burden, and we're talking about people who are maybe 3.5 and they're holding, the couple together now has gone to seven, let's say 5 million's commercial property, they've got some cash there and 2 million, they can afford to pay the extra tax. They've got the cash flow. They can afford to pay the extra tax.
So let's just have a look at the scenario because again, I'm just going by questions that keep coming through where they're saying, all right, they've got this property that's worth 4 million. In order to move it into another entity, to move it out of there, what does that involve and what's that going to cost them?
Cost them a lot. There's stamp duties. There's
There
going to
we
be
go.
stamp duties a
Okay.
killer. Stamp
Yeah.
duty is a killer. It will definitely be the killer. I do believe if they take it as an in specie lump sum, that means they pull it out as a pension payment,
Yeah.
then which they're entitled to do once you're retired, then you can get exemptions on that.
But that would be the cash. It wouldn't be the asset.
The asset will have exemptions on stamp duty.
Yeah.
Yes.
Okay.
There are exemptions. So the stamp duty, it can be exempt. If it's all paid off, I'm pretty sure if there's no loan on there and they transfer it to their own name as an in specie transfer, they can have that stamp duty free.
Is there a cutoff for that stamp duty? Is there a ceiling?
I don't think there is. I'm just going to look that up. Stamp duty exemption, and that's lump sum property transfer. I have looked at this before, and because I've got clients with properties I want to bring back out again.
Mm. So in other words, it's basically leaving the asset in the self-managed super fund, but drawing the capital out of it.
No, you draw the whole property out. You take it out as a lump sum
You take the whole property
payment,
out as a lump sum, but then you're paying that stamp duty. If
exemption on the stamp
if
duty.
but surely the exemption would have it should have a cap on it.
I don't think it does. I really don't think it does. I have looked into this to a client before. If you move a property out as your lump sum, because it's going, if you say it's a husband and wife,
Yeah, so
to
it's
say,
husband.
yep, let's say it's husband and wife, and so the husband and wife are in the fund, and the husband and wife pull that property out into both their names, so there's no
Mm.
stamp duty.
So they would put it in their names. So they'd have to put it in their names, not into an entity.
No, they can be wherever they want, but I technically they have to put it into their own names first.
Okay.
Because it has to be the member. So it has to be if the basically the ownership right hasn't changed, because those
Yeah.
two are both members of the super fund and had control, the members get the benefit of the property. No stamp duty, there's an exemption. I know there is in Queensland. I'm not sure about the rest of Australia.
I'd be interested to know whether it is the rest of Australia and
I could find that out quite
what
easily. I'm
does
trying to
it.
look online, but of course they make it difficult. Anything with super is hard to find online. But that's why they have us.
Yes, anything to do with this is going to be hard to find.
Yes.
Absolutely. Okay.
Yes.
Now, what is the age threshold for doing that? If they want to move their property out and put it into their own names?
Yes, either over 60 and retired or anyone over 65. There's no
Okay.
restrictions on how much money you can take out.
Right. Okay.
Yes. Yep. So 60 if you're retired, 65 for everybody. It's like a bank account, your super
Yeah.
fund once you hit 65.
All right. So if the shoe's on the other foot and you've got that load of cash that's sitting there, and you've got children that are battling to buy investments, battling to buy homes, whatever, you want to help your kids out. Would it be advisable to, let's say you've got 3 million, would it be advisable to use 2 million of that, buy property for 4 million, put it into the self-managed super fund, or what entity would you advise that they put that into?
When they're taking it out or if they're transferring it out?
Well, they're taking 2 million out and they're going to buy commercial property. All right.
Hmm.
What entity do they put their commercial property? They're 75, they've maybe got another 10, 15 years left. They want to help their kids out.
You just gift it to the kids.
You gift it to the kids and the kids put it in.
Because if you've got 2 million cash you're pulling out of a super fund, you wouldn't be buying commercial property because you would already have that commercial property within the fund already.
Well, not necessarily. I mean, we've got a couple of people that have got that cash in their self-managed super fund. They don't have any properties in their self-managed
So
super fund.
then why would they want to pull it out and buy property?
Well, they're wanting to help their kids, and they're saying, well, if they're going to get taxed on the 3 million, maybe what they should do is just pull 2 million out, give it to their kids to buy commercial property so that the commercial property is growing in interest. And as you said yourself, whatever you're paying 2 million for it over today or 4 million for it today, and in 10 years' time, it's going to be worth 8 million.
Yeah.
And whether they're going to be here or not is the question. So with regards to that 2 million that they're gifting to their family, to their kids, would you advise that those kids buy a commercial property in a self-managed super fund or in an entity, a totally separate entity?
I'd still say self-managed super fund.
Okay, so
It's still the best tax rate. It's still the best tax rate you can get out of
yeah,
every entity. The
okay.
super fund is the best. So I think we also need to know another thing this is it really flows on from here. There
Hmm.
is such thing as inheritance tax. Everyone, there's always some drama about it every election, inheritance tax, inherit. There is an inheritance tax. When you pass away in a super fund and your money goes to your non-dependents, which is any child over 18,
Hmm.
is a non-dependent. A dependent is someone who's disabled, got a disability, or an
Right.
under 18. That is a
Mhm.
dependent. Not many people retiring and dying at 80 have dependents under 18. So their dependents over 18 are non-dependents for tax purposes, and there is tax. There's 15 cents in the dollar or 30 cents in the dollar, depending whether you got a tax deduction for the money going in when you put your money into the super fund originally. So there is an inheritance tax. So a good financial planner or accountant will tell someone in their 70s and 80s, you need to start cashing out. So this is perfect time now. This is the perfect timing. You can only have 3 million. We've got 3.5. Time to cash out. Time to liquefy. You don't want to leave those assets in there and leave that tax burden to your children. So we used to say in the old days, die with a checkbook in your hand. So now you've got to die with your internet password for internet banking on your forehead.
Or your mobile phone in your hand.
It's something. So if you transfer all that money the
Yeah.
night before you die, you take all your money out of super and give it to your kids, tax
Yeah.
free. If you die the next day and haven't done that, 15 to 30%. So let's say on $3 million, do your maths on that. That's a lot of money. That's probably more money than what they're talking about with this new tax we're talking about now. But nobody's talking about this tax. Nobody knows about this. Every client I talk to that sets up a self-managed super fund, I say to them, do you know this money when you die is not tax-free to your children? They have no idea.
That's amazing. I didn't actually know that, so thank you for
Nobody
bringing that to
does.
my attention. Yeah.
And that is the tea in the storm cup. That's a conversation we should be having. That's someone's hard earned money after tax dollars going again and getting taxed again. Now, that is double taxation. That actually is the question it should be. That is double taxation. That this money we're talking,
Yeah. So that means that
yes,
for every dollar
yes,
that you've got in there is being taxed at 60%,
yes,
because it's
again.
30% when it went in and 30% now
And
when it's going
again,
out.
and again. So not exactly that. We shan't quote that because I'm pretty sure it's 15% going in and then it's going to be other 30 or 15 coming out. But
Yeah.
anyway, that's the
Cool.
conversation people should be worried about because everyone's got super in there and it doesn't, there's no threshold on that. It does, if you've got a dollar going out to them, it's still 15, 30. If you've got 10 million going out, it's still, these are the questions that should be getting asked. But instead, we're all looking this way, look this way, look at this, don't
Yes.
look at this.
Yeah.
So this tax we're talking about today is a storm in a teacup. It affects very, very few and it doesn't take much planning. And if you're that old and got that much money, it's time to liquefy anyway and get it out to the kids.
I love the way you say
Solution
that. Just get it
done.
out.
Simple. It's simple. Just get it. You're going to get it out anyway. Or do you want to pay the kids to pay tax on that? Do you want your nest egg of 6 million getting taxed at, on average, if you go 15 divided by 30, and 30, you get at least 22% tax on $3 million times 22, you're looking at $660,000 gone. And that's money
Wow.
that already has been taxed. That's not
Oh,
earnings.
no.
That's the balance of your super fund that you have put in there and worked hard for. That's a conversation we should be talking about.
Absolutely, and I think it's what we can carry on talking about. So just to confirm that if you're taking that money and you're gifting it to your kids right now, there's no tax on that whatsoever. You mean to tell me that your kids are going
No,
to
zero.
zero, so they're going to receive $2, $3 million, whatever it is, whatever that number is, for
Yes.
absolutely zero, zero. Well, I can tell you, I
Yes.
think this is going to be a storm in the teacup, because for anybody that's listening to this, they're probably going to be doing huge negotiations with their parents to start pulling that money out of
Yes,
that
yes.
custody.
Especially as soon as you get 80, 85, we're having these horrible discussions in
Yeah,
my office. I have to say to them, have you got an exit strategy? What you've got all these millions tied up in all these assets. They're not very liquid. If you
yeah,
get sick very suddenly, they're going to be very hard to move out. So we try and liquefy. So you get the commercial property when you're in your 40s, 50s, 60s.
yeah.
You make your money in your 70s, 80s, and you cash out and you liquefy in heading towards your late 80s.
So, Kerry, what would happen in the case if you've got a self-managed super fund and you've got your kids in that self-managed super fund and your kids are in their 30s, 40s, 50s? What would happen in that case?
Same, same.
Exactly the same. So they still get taxed.
Yes, it stays within the fund. It
Yeah.
doesn't have to leave the fund, but it's still
Okay.
taxed. We still do a
That's
death benefit payment summary, and they
yeah.
still pay tax on a death benefit payment,
So
it's
they're
called.
still going to pay that 15 or 30%
Yes,
on the
depending on,
deceased estate,
yes,
despite the
that's
fact that they're
correct.
actually in the
That's
self-managed super fund.
correct.
Ouch. Okay. So
Yes.
if they're in the self-managed super fund, and how would they transfer that to their kids if their kids are already in the self-managed super fund? Do the kids have to go and start another self-managed super
No, they can
fund?
stay in there. They stay in there. So normally you have a corporate trustee. So
Yeah.
two members just die off and their balances go to wherever their will says. So if their will says give it to the two children that are already existing, that
Mm.
money less the tax goes to the kids' members' balance within that fund. Less the tax. They pay that tax that year.
Okay, so if they're in the self-managed super fund, they're still going to be taxed. If they're
Yep.
outside of the self-managed super fund, they wouldn't be taxed.
They still be taxed. Both of them still get taxed.
Okay, so in which instance can they avoid the tax? If somebody does.
They can't ever. Unless they pull it out, oh, checkbook in your hand. Checkbook in your hand. That's it. Internet banking password tattooed on your forehead.
Wow.
Just to give you a little bit, my uncle passed away recently and he got really sick very quickly.
Hmm.
And his daughter rang me and she says, "What do I do?" I said, "Cash out, cash out, cash out." That's the first thing she did. Cash
Right.
out, cash out, cash out. They got all that cash tax free.
Wow.
He
Okay.
had over 1.1 million. We worked out we saved them over $220,000.
Wow. Gee, that's a huge saving. That's a massive
Huge
saving.
saving. That's the more discussion we should be talking about. And that
Yeah.
affects everybody. Everybody dies.
Yes.
Not only 0.5% have over 3 million. 100% die. Hey? Let's talk about things that actually matter. Let's talk about things that can actually affect your bottom line.
Yeah, so you're talking about the $1 million that's sitting in the self-managed super fund. Cash out, cash out, cash out.
Cash out,
Thanks.
cash out. As soon as you're sick, as soon as you're going into palliative care, as soon as you know your
Yeah,
days are numbered, you
yeah.
you got a terminal illness, you're cashing out.
Cash it out. Okay, well, I
Cash it
think that's
out.
that's great advice. That's absolutely
Mm.
great advice. And so, yeah, how do we bring this back to commercial? What does this mean for commercial property as a whole?
Oh, look, commercial property is not going anywhere. Property in Australia is not going anywhere. They really are making a storm in a teacup. Let's say, for example, people did want to get their money out. Right, let's just
Yeah.
go, okay,
Okay.
I've got 10 million. I've got to get rid of 7. I need to liquefy. I need to pull this out. They take out their 7 million. They might take it out as in specie transfer and take out the commercial property. All
Now,
they
what
do
does
is move
that
it.
mean? You mentioned in
In
species.
spe so, yeah, so it means you're taking not taking out cash, you're taking an asset out of the super fund. So instead of
Okay.
taking 7 million out, you're taking it's called in specie because it's not cash. It's pretty all you're doing is moving that property from the super fund to yourself.
Okay.
Right.
And
So, so
you're gonna pay stamp duties on that.
no, you're not. So I've looked that up for you and I found the answers. So it's $500 in stamp duty in New South Wales.
Wow.
It's no duty in Victoria. Yep. It's no duty in Queensland. It's $20 in WA and ACT. It just says ad valorem duty applies. Who knows what that means? And South
Mhm.
Australia. So ad valorem and $50 in Tasmania. So if you are the member and it's your balance, you've got 7 million in your balance in your super fund and your commercial properties worth 7 million of that or 5 million of that, and you want to take that out and you're over 65, you can take that commercial property out of your super into your own name and you pay tax on the profits.
Wow. Okay. Well, that's a
For
huge thing.
$500. There's no drama there
Yeah.
whatsoever. There's
Yeah.
no problem. And you want to cash out anyway. So you probably then change it to your children. Maybe, I'm not sure, you sell it, you're going to have capital gains on it. So
You're gonna.
9 times out of 10, let's be honest, you're going to keep it in the fund.
Yeah.
You're going to keep it taxed at 30 cents the dollar. You're going to keep it in the fund. You get a,
So
mhm.
let's look at another scenario. What if you own this commercial property? You've got your $5 million commercial property. You die, and your kids obviously are inheriting that property.
Mhm.
Now they're paying that inheritance tax, aren't
They
they?
are. They
Yeah.
are.
So in actual fact, you not only need to get rid of all the cash, you need to cash out, but you need to move those commercial properties into somebody else or into your own name.
Yes, into your own name. That's when you get the
Okay.
stamp duty exemption.
Okay. So you move it into your own name and you still die. If you were to move it into your own name and you still die, you're still going to be paying, your kids are still going to be paying some sort of tax on it.
Well, listen, this is the beauty of that. So let's say they did transfer it out, paid the
Yeah.
$500 stamp duty, had it
Yes.
in their own name and passed away. It
Yes.
goes to the children at the cost base it was when it came out of the super fund, not the cost base they bought it for in the super fund. So when they take it out, it gets a new
Mm.
cost base. So let's say they take it out, it's worth 5 million for the
Yep.
argument's sake, take it out of their super fund. So it's valued at 5 million. When
Yeah.
they die, it goes to the kids. The valuation is 5 million. The kids sell it for 5.5 million. They're only paying tax on the 500,000.
Ah, so they're only
It
paying
resets
on
the
the
cost
difference.
base. Yes, when you
Right.
transfer it.
Right.
Yes. So
Okay.
very good tax planning.
Okay, well there we go.
Mm.
There's an answer for a lot of people because a
Hmm.
lot of people are sitting on this pile of cash, wondering what to do. Do they buy commercial? How do they buy commercial? And I think there are a lot of people that are sitting on beautiful assets in their
Hmm.
self-managed supers, and they're thinking. So my question is, what is this creating? Is it causing panic selling?
Not yet. I think the ones with the billions might have a bit of a problem, but even then, if they've got that many billion, where are they going to get a 30% tax rate outside of super when you're talking billions? So I
Ah,
think I don't think it'll affect the billionaires. I think they'll stay put. I think your ma and pa that might have 3.5 million, 4 million might be thinking, time to give the kids some money. Let's maybe transfer a commercial property, or let's keep the commercial, let's give them some cash. What are they going to do with that cash? They've got to do something. They've got to their account. Mum and dad are giving me 500 grand. What do I do? Negative gear. Let's get some property. Let's get commercial property. That's the question. That's the answer that's going to be told by all financial planners and accountants. None of us are going to tell you to keep your 500 grand in cash. It earns
of
piddly
course.
whatever into slow interest bearing. You want to grow your asset. Any decent financial planner or accountant is going to say let's negative gear that and buy something.
Yeah. Okay. So there you go. So spend the money, buy commercial property, and watch it grow anyway.
Yes, and the beauty of that is super funds, you can only transfer two things into super funds. Well, there's three things. You can put cash in, you can transfer blue chip shares. For example, if I had BHP shares, I can put them into super as a contribution.
Right.
So if I've got 100 grand's worth of BHP shares, instead of giving 100 grand cash into my super fund and getting a deduction, I can put my 100 grand's worth of blue chip shares into my super fund, treat them
Okay.
like cash. I can also transfer commercial property into super funds.
Without any stamp duties.
What's the stamp duty going in? I've got it going out. I can't remember what
Mm.
was going in. Stamp duty on in specie property, it's called in specie transfer. You're going to learn a new word today because they love these jargon. That's what keeps me in a job. Stamp duty
Ah,
on in specie transfer into an SMSF, real business property, which is commercial, but they call it real business property. While the transfer, an eligible property transfer into an SMSF, same thing, $500, same as
500
going out.
bucks. Ooh,
But you can't
okay.
have it. I don't think it cannot be encumbered. It can't have a loan.
Ah,
Mm.
that's the big draw. So it's
Yes,
got to be totally
it's got to be
unencumbered.
owned outright. Yes, parents. So let's say those parents pull out their property,
Yeah.
give it to the kids, small gain because it hasn't gone up from when they pull out the 5 million in property. It's worth 5 million. They give it to
Yep.
the kids. Brother and sister go, let's put 2.5 in. Let's put this property straight back in again. $1,000 stamp duty, and they've got their property and they're set and hosed. They don't need to worry about super again. Set and forget.
So they put it back and they can put it back into their supers straight
In
away.
their name. Yes.
Yeah, so
Yes.
it can go
Unencumbered.
from mom and dad into brother and sister, whatever, and
Yep.
then straight into their supers
Yep.
at
Yes.
wow.
Very minimal cost. Yep.
This is gold, Kerry. This is absolute
Yes.
gold, and I hope for the listeners that are hearing this are really getting this because I think this is the kind of stuff that people don't really talk about. I mean, most accountants don't tell you about this.
It's called financial literacy, and I'm glad you mentioned that because I'm thinking of branching out into something like this and doing something like this called financial literacy. There's
Yeah,
accounting and doing your books and your GST. There's financial planning, getting in a wrap fund and doing all these kind of things. But there's something called financial literacy. Where do I put my money? Should I get blue chip shares? What's the point of blue chip shares? Oh, you can transfer them to your super fund. Why should I cash out my super? Because it's tax-free dependence. These things don't come up in a daily conversation when you're talking about your annual end of year bookkeeping and GST. It's not succession planning. It doesn't fall under any umbrellas right now. But I think
wow.
it's a big part of the market that's missing. And I'm naming it financial literacy. And I think we all need to learn it. Mm.
I'm going to absolutely support you in that, and I think we're going to have to do another one of these
We will. And we'll call it
shows.
financial literacy. Yes. We might have
And
to
it's
start charging people for the podcast, though, Mish, because this stuff is gold, as you said. If you've sat with me
absolutely
in a meeting, this is worth thousands of dollars. This is accumulation of 29 years of, education and interest in my
yes.
certain topics. So
Yeah,
yes,
it certainly
yes,
is. So we definitely
yes.
going to have you on again and have a
Thank
chat
you.
about this.
Mm,
This is really brilliant. So you pretty much answered the question, but I'm just going on a couple of questions that
mm.
come in, and this, as you said, this tax, it's a storm in a teacup because it's only affecting 0.5%, and it really is a tax that's going to be affecting the rich. However, the tax hasn't come into legislation just yet, has it?
It's guaranteed. It's guaranteed. So
Really?
yeah. So yes. So Labor has the upper house with the Greens. They don't need anyone else's votes, and the Greens have already supported it. The Greens have already asked for it to be 2 million instead of 3 million. So it will come in what
Hmm.
shape or form. It's 100% coming in. There
So
is
it
no
is going
ifs
to
or
come in,
buts.
but
Hundred percent.
it might not be that number.
It could be 2 million if the Greens want it 2 million and have it indexed. And Labor wants it 3 million. But that's the only things that's going to change before this legislation gets in. It's coming in. It's guaranteed to come in.
Okay, so with all due respect, if it's 2 million, it's going to affect more people than if it's 3.
Yes, but it will be indexed, but it will be then indexed. So
Okay.
then 2 million today will go up with CPI for the rest. So therefore, that's a lot fairer in the long run.
Yeah.
And it catches a few in the short term. But once again, the Greens argument, which is a very valid argument, you've got $2 million in your fund, you're 80 years old. It's not meant to be a wealth creation. It's not meant to be a tax haven. It's not meant to be like the Bahamas and you get tax-free money. This is meant to be, it was brought in to give people a dignity. So they're not living off the government, trying to
Yeah.
scrape pension. And let's be honest, we started our pensions at 9%. It was 5% back when in my day. Now it's
Yeah.
12% of our wage goes into super.
Yeah.
So it's not meant to hold hundreds of millions of dollars for people then to keep getting tax, concessions on. So 2 million, 3 million, how much do you need to live on? The average rate of earnings in Australia on a super fund is 10%. So on that 2 million, you're getting 200,000 in earnings without even touching the capital. So you've got two people with 2 million in each earning $400,000 a year. Think about that. That's a lot of money. That's that 8 grand a week or something ridiculous. What's four
Yeah, it
hundred
is.
thousand? A bit slow on a Friday, is it?
Yeah, it is. It is about
Divided by
that is
that's $7,600 tax-free income without touching your capital. You can't tell me two people in their 80s need more than 7.5 grand a week. Come on. But you got to put it in perspective. You really do. That's on 2 million. Average return 10%.
at the same time, I mean, it depends where and if you're living in a home, what type of home, what level of care you're in. There's so many, parameters around that. There's so many different.
Even then, if you did need more than seven, you need 8 or 9, you're starting to slowly erode the capital. So
Yeah.
your 2 million goes down to zero by the time you die. And that's what they wanted. They don't want intergenerational wealth. They don't want people dying at 87 with $7 million in their super fund. That's not what it was for. That's not why so that's why things are going haywire now, because in the early 2000s, we let them put $1 million in. So it's
Yes.
poor decisions made by the government, as usual, over time. It's like the old cane toad. You get the cane toad to take the cane beetle, then everything's there in the cane toad. Now the cane toad's a problem, and you bring something else. That's
Mm.
what we've done here. So chicken or the egg. We've let the horse bolt in the early 2000s. Now we need to rein them in.
So, what do you think the answer is? Is to tax it the way that it's been? You're in support of the tax.
I wouldn't say yes. I'm in support of the tax, because now what else we haven't talked about today? We need to talk about. They've
Yes.
now restricted how much you can put in every year. So the maximum you can put in after tax is 120. The maximum you can put in before tax, so get a tax deduction for, is 30. That's 150,000 a year. Is the most you can put in as an individual in Australia today. There's also things like when you have a downsizer, when you sell your house, you can put an extra 300 in. When you sell a business, you can put some money in there. I think it's 1.7 you can put in if you sell a business. So it's very hard to get money in there now. So we're not going to have this problem in 20 years, Mish. This is
Mm.
not going to exist. So it's like a restart. So we sort of hit the button that, hey, you guys have had it too easy for too long. We kickstart it, we restart it. They take all their money out. We're never going to have this problem again in 30 years, because you and I can't get that much money in there. Putting in 150,000 a year is not going to get us up to 3 million by the time we're 60, 70.
So, what's the idea with 150K per year? I mean, are they saying
To
that?
stop this happening again.
Yeah, ideally, what are they saying that in 10 years' time you should be living off 150K a year per year?
No, they're saying putting 150K in now, a year, if you did, with compounding interest, by the time you get to 60 will be enough to live on. If we let you do more, we're going to have this problem again. We're giving concessions to the rich. So we
Yeah,
don't want you to put in more than 150 a year.
yeah.
They do nice things, like they let you carry forward. They let you put, instead of 120, you can do a bring forward rule and put 360 in 1 year. With your concessional ones, your 30,000, if you didn't use up your 30,000 last year or the year before, they let you carry forward 5 years in advance. So there are ways to get it in, but they
Mm.
don't want you putting $1 million in now when you're 25. Because where's that going to be by the time you're 60? That's going to be another $20 million that we're giving you concessions for.
Yeah,
Now, should we be subsidising people with $20 million in their super fund?
yeah.
Do you think that's fair?
I want to bite my tongue over here, but I'm thinking maybe what they're going to have to do is start bringing in some rules that when you get to 70, you have to relinquish a certain amount. When you get to 80, you need to
They
relinquish.
do, they do. So when you go in retirement at 65, when you're 60, you have to take out 2% minimum. When you're 60 something, it's 4% and 6%. The rates go up. I'll get the exact rates for you. So you do have to take out a bare minimum every
Okay.
year to give
Okay.
you that tax-free status. Because that's what they
Right.
did do. They thought if we just give you tax-free status and you just leave the money in there, what's the point? So you actually do have to take a minimum pension amount. It's a percentage, minimum pension amount each year. So I'll see it probably gone up this year each year. It depends on your age. So as you get older, you have to pay more. So when it's 4% for 65. Once you get to 65 to 74, it's 5%, 6% for 75 to 79, and 7% for 80 to
Okay.
84.
So it's
And
still
that's to make
minimal.
sure you're still just pulling the earnings. On average,
Yeah.
like I said,
Yeah.
a super fund's netting 10% on average.
Yeah.
That's capital growth and return. So if you look at commercial property, you're netting about 7% after rent, but it's going up about 4%, 5% every year. So it's actually netting you in total 12% a year.
Okay. That's
Yeah.
yeah, that kind of makes sense, I guess.
Hmm. Hmm.
Depending on where you are in your journey, how much self-managed super fund that you have, that you've got, what age you're at, and where you
Well,
take.
let's put it in perspective. You and I could not get 3 million in tomorrow. If we can put 150 grand a year, what's 3 million divided by 150 grand? Oh my goodness! And let's be honest, now the cap's 1.7. You can put in. It can grow to 3 million, but you can
Yeah.
only put in 1.7 million dollars. So 1.7 divided by 150,000 maximum. Yeah, you're looking at yeah, you're not going to. It's not going to happen.
Yeah.
110 years old, you have to be.
I think there's probably about two or
And
three
I'm
people
hoping I'm
around the
dead
world.
by then. I'm hoping I'm dead and not worrying about this then, I'm sure.
Absolutely. Yeah, that's we won't worry about that right now.
Not right now.
So, Kerry, in your opinion, what should people be doing within their self-managed super funds right now? I mean, by the sounds
Nothing.
of things, it sounds like it's time to maybe have a look at it, to rethink it, to see where you are, how long you've had it for,
I think it
maintenance.
should be the same as what it should have been years ago, and you should be worried about inheritance tax more than anything. Let's be honest, anyone with $500 million in their super funds got advice from people bigger than you and I. They don't need our opinion today. So we're talking about where you and I, the mums and dads, are sitting about 3 to 3.5. They're probably about in their 70s and 80s and probably had some really good investments and really did very well because not many people will have that kind of money. So they've had some probably ex-accountants or, ex-financial planners who've had some good advice. So it's sitting on the 3.54 million right now, or they've sold a good business. What they should be doing now is looking and saying, do I need this money in this super fund? Am I happy to pay 30 cents in the dollar? If I pull it out, will I be paying 47 and a half cents in the dollar? If so, keep it in. If I can give it to children, I've got other avenues to spread this money. Let's do it. So my advice would be go and see a good accountant and a financial planner and decide what is the best course for you. Let them do the maths for you and say, this is what happens if we take it out and you get taxed on it. This is what happens if we keep it in. Find the best scenario that works for you, the least tax, or you want to help your kids out, do it now. Why pay the tax to the government, the extra 15 cents? Give it to them, let them start growing their new next wealth generation. And you can see that grow. So my advice would be talk to a financial planner or a very good accountant who's in the super sphere, who understands super, and let them do the maths for you and take that decision away from you.
Absolutely. Absolutely. So if you were having this discussion with Jim Chalmers right now, what would you be saying to him?
I'd say good on you, Jim, but let's just index it, mate. Because that house that Stefan bought all those years ago at $1 million is worth 30 now. So that 3 million is going to really not be worth anything. You can't even buy a house for $1 million. So
No.
I would say index it, keep them quiet, index it, keep it where it is. You're doing the right thing. We don't need more than 3 million in our super fund to be able to retire. It could be accidental that we buy a property and it goes up 10 times and it gets over the 3 million you didn't mean to. It just means you've just got to pay a little bit of extra tax and you should think, great windfall. I'm happy to sort of give back to Australia, give back to this beautiful, lucky country that I live in, with our great resources, our great clean roads, our infrastructure, our hospitals. My friend just came back from Egypt and said it was a hole, goats getting cut on the side of the road. It was filthy. There's a highway with people walking on it, literally an M1 with people walking with goats. Now, this is a country that started with the Nile and all the things they built in pyramids. Look at them now. Look at
Mm.
us now. We started from nothing. Look where we are. So sometimes a little bit of tax is not the worst thing in the world.
Okay, well, I think that is valid. And I always say this is the lucky country. We came to this country because it was the lucky country, because we come from a country, Africa, and is exactly what you've just explained there. I mean, I come from the southern end of Africa. That's happening in the north, but it's happening right through Africa.
Mm,
So when you arrive here and you see these beautiful roads and beautiful parks and beautiful kids spaces, and there's just so much. I mean, this country is just it's just a wealth for its citizens that I really am truly, truly grateful and I think privileged to be an Australian now. So, Kerry, powerful words, and I want to thank you for your insights. I want to thank you for this conversation. You jumped
you're
on this
welcome.
moment, it was great. There's so much that we could speak about, and we could carry on talking about this for quite some time. I'm
Mm.
definitely going to have you on for a couple of other topics. And for our listeners, whether they've got self-managed super funds or thinking about self-managed super funds or planning on their retirement, where can they get hold of you?
Just Google me, Bridgeland Finlay Accounting. My name's Kerry. Been in this, 12 years in this business. I've been in the business 29 years and very passionate about super. So if anyone is interested or thinking of it, happy to give them a little bit of helping hand or go from where to go and help them set up a fund and start their journey. As we said, it's the only thing that's tax-free in Australia is super. So it's the way to go. Well, that's what tax accountants want. We want negative gearing, we love debt, and we love tax-free. So
Absolutely.
it's a no-brainer.
Everybody wants something for nothing, and there it is. You can have your
It
tax
is.
on your
You can.
super.
You can.
We are going to put Kerry's contact details into the notes, people. So if you're listening to this and you want to contact detail and you want to contact Kerry, we'll have Kerry's contact details in the notes. And again, I want to thank you and to come onto the Revolve Commercial Smart Property Talk. And people, don't forget to subscribe. Don't forget to share this. I think this is an absolute gold mine that we've just chatted about. Share it with your family, share it with your friends, get it out there. And thank you for those of you that are giving us likes on this podcast. Really appreciate it. Every single little like that we get and every single share makes such a huge difference. We want to share this information as far and wide as possible. So again, Kerry, thank you very much. Last little bit of advice for our audience.
Don't listen to the media. Talk to
I
the
love it.
professionals.
There we go. Love it.
That's it. Don't listen to the media. Talk to the professionals. They'll tell you exactly what's going on.
There we go. Great
Yes.
advice. Thanks again, and see you on the next one.
Lovely.